What's up, everybody? Joe Brown here. This is the Heresy Financial Show. And earlier there was a flash crash that took place in Europe. Massive, very quick selling, prompting stocks across Europe to sell off close to 8% before just as quickly recovering. So we are going to talk about number one, what just happened, and number two, how you can protect yourself against having something like this screw you over. Ready? Let's dive in. All right, so now we know the culprit behind this flash crash was the result of a large trade, and it was by Citigroup. Citigroup's London trading desk. If we take a look here, sent shares down 8%. And so we can look at this chart here. This is what happened. It was an extremely quick sell-off there, and just as quick almost a recovery up to almost where it was before, and then slowly throughout the rest of the trading session worked its way back up to where it was before that crash. Now we can see here that it was Citigroup's London trading desk that was behind the flash crash. So how in the world could they have caused a crash like this? Well, basically it was triggered by a large erroneous transaction. And so they first ruled out that it was technical issues. So that was what Nasdaq had to do. They had to make sure that it wasn't just a glitch, technical problem here where everything started selling off or looking like it was selling off, but it wasn't actually. So they made sure it wasn't a technical error. Next thing they had to exclude was an external attack on the systems, like hacking, and it wasn't either. And people who didn't want to be named said that it was Citi's London trading desk. And further than that, they're not going to be taking these trades back. This isn't the London Metal Exchange. When trades happen, they actually happen. You can't just void out an entire day's worth of trading. And so Nasdaq is not going to be canceling these trades, even though it's probably going to cause Citi a massive loss. Couple of things that are very important to note about this. Number one, erroneous trade caused an 8% drop in minutes that fully recovered. So this was not intentional. Imagine if there were some players who had accumulated a large positions in any number of stocks or positions, and they were able to they just wanted to make the price go down extremely rapidly. They didn't care about their own losses because maybe they have access to a money printer, maybe it's a state-sponsored fund, or maybe it's backed by a certain state that wanted to negatively impact the economy of a specific country. Something like this could have been done intentionally. Obviously, this one wasn't. This apparently was an accident, but you can just imagine if somebody that was state-sponsored was able to accumulate a sizable position in something that they wanted to cause pain to, they could liquidate a massive amount very quickly, and they could trigger a flash crash. The second thing to note about this is that it was just one player. And we've seen flash crashes happen before. We've seen flash crashes happen, and largely they were due to factors other than just one big player making a fat fingering a trade, basically. Another area that we've seen this happen from is because of indexing from passive investment. So this gets into the kind of the debate between passive and active investing, where you go to your typical ETF. It's going to be passively managed, and so any money that comes in is just automatically allocated to the stocks in that portfolio. Jack Bogle from Vanguard, he pioneered this style of investing, whereas before that it was all basically active. So individual money managers, you go to your financial advisor, they'd pick out some stocks for you, and most money management, most investing was done on an active basis, where investors were looking for the best deals. They were buying stuff when it was really cheap, trying to sell stuff when it was really expensive. And so from those two extremes, you have the continuum where we have been massively approaching too much passive investing over the last few decades. It always used to be active. Now a lot of it is passive. What that does is it introduces some systemic risks. There's less real price discovery. There are fewer investors who are seeking value. And so you just have algorithms that many of them, all of the S&P 500, the aggressive, the stock, the 60/40, all of the main ones that all the 401ks, the retirements, the IRAs, the managed brokerage accounts, all of them are invested very similarly. So you've got all these passive algorithms that have the same rules associated with them about how to invest. And so they're not based on value at all. They're just based on allocations to specific types of stocks. And so when everything moves up, they'll either buy or sell, very, very similar to each other. So there's not as much price discovery in the markets, which means when something starts to drop, you don't have as many active investors out there who are looking and saying, hey, I want to buy this now that it's dropped, or hey, I want to sell this now that it's gone up. So you have more and more and more volatility enter a market, the less active participation you have in it. Further than that, it opens up the doors for things like this, like flash crashes, because it triggers a lot of automated responses. And so there are many people out there that have things like 5% stops on their stocks. This is a terrible idea in today's day and age, where you can have flash crashes, where you can have computer automated and generated trading that sells and buys based off of specific factors that will cause something like this to happen, where somebody fat fingers a trade, it's too much, and then it starts tripping and breaking all of everybody's stops, hits everybody's stops all at once, and it hit 4%, then 5%, then 6% down, then 7% down. That triggers everybody else to sell, because you're thinking, oh, well, it's going down now. It's gone down 5% from where it was. That means I want to get out. And so everybody starts selling, which drives it down even faster. So this is a terrible idea to have stop orders as a tool to protect yourself against losses, because you've got flash crashes like this that happen where it goes down, you sell at 5, 6, 7, 8% down at wherever it was that your order got filled, but it was a flash crash. It wasn't real. It wasn't based on any news or any fundamental change. It was just based on, an error or a fat finger. And very quickly, then the market, whoever is actively investing, looks at it and realizes, oh, hey, this is going to go back up. This was just somebody accidentally sold, or this was a glitch, or this was whatever it was. Everybody buys, but your stop order isn't set to buy back up on the way up. That's not how stop orders work. So you're left out of the position with cash. Now it's back up to where it was, but you sold 5, 6, 7, 8% lower. So using stop orders is a terrible way to hedge yourself or protect yourself against losses. Instead, use something like protective puts. You'll pay for them, but at least you get the guaranteed sale price if it starts to drop. And if you don't want to actually sell a position, you can just take the appreciation on the put contract by selling the put. And so that's a much better way to guarantee protection, is by using options. Yes, you have to pay for it, but with a stop order, you're not guaranteed on the price that you have to get out at. And even with using something like a stop limit order, then you're just not guaranteeing that you actually get out. So in the case of a real drop, if you have your limit set too high, if you have your stop set at 5% and maybe your limit set at 10%, but it's down 15%, it's not going to sell unless it comes back up to that 10% mark. And so it's possible that on an open, if it gaps down, you're already past the point of your limit. So you can't guarantee both execution and price unless you pay for it by using something like a protective put. So I hope that clears things up for you. At the end of the day, flash crashes that are a result of errors usually do come back up just as quickly as they went down. But in today's fast-moving environments where unexpected things are basically should be expected now, we should anticipate more and more volatility going into the future, not less. As always, really appreciate you guys. Thank you so much for watching. Have a great day.